Tonight we want to talk about a few things. Forms of doing business in another country, consolidated versus separate entity taxation, something about governmental incentives, local equity participation requirements, tax effective locations, and also we will talk about it at some point, the Khoo Holdings case, which we introduced last time. What I would like to do here in terms of talking about this area is try to build up what doing business in another country means, focusing on activities and what the consequences of those activities are toward your choice of what form to use when you do business in another country. So, with that in mind, as we discuss things, you will see activities, in other words, what are employees doing, where are their offices, what activities are there, where is their inventory, what contracts are there, those sorts of things. And you'll also see something as we talk about legal form or legal status of how let's say, what box those activities are within. So we're going to discuss both of those through the process of trying to build up activities in another country. Now, notice the bottom part of the slide. We will build up the activities and we will intersperse that with these different, call it the status or legal form, which I first entitled no presence. In other words, if we are looking at X, if this is country B, and this is country A, and X is in country A, what can X do? What activities can X conduct before it actually has some sort of recognized presence from a tax standpoint in country B? So this is what I mean by no presence. What can X do before B says, hey, you're here, I can grab you? The next one after no presence is representative office. Now, representative office normally does not have a real legal meaning, although some countries let's say recognize it in some way, but usually it doesn't have a real legal meaning. And we'll talk more as we get into it about, well, gee, what is a representative office? The next item, branch of a foreign legal entity, that again may or may not in a particular country have a real legal definition, but we usually see it as being where a foreign company, where X in this case, has enough activities in country B that it probably has a need to register in some way as a foreign company doing business within country B. And the last one in this was some sort of locally formed legal entity. For example, if X were to actually form a subsidiary, put a box down here, which is wholly owned, for example, by X. So no presence, representative office, branch, or some sort of locally formed entity. So we're going to be talking about activities, we're going to be talking about these 4 items and other legal status or legal form things that come into this. I hope also that this discussion, building up, focused on activities, will be a little bit of an indication to you, a little bit of a reinforcement of what I say about having a blank sheet of paper, where you can draw the boxes that you think fits the fact pattern and fits the rules of the relevant country you're talking about. That your imagination and creativity are important here, and you really do have a blank sheet of paper. What business should we assume that X is in? Let's say that X is manufacturing tables and perhaps chairs. Let's say that X is manufacturing them in country A. Let's say that A has a good business in country A. It's selling lots of tables and chairs and everybody is happy. Let's say that somebody in the marketing department says, gee, you know, we ought to advertise these tables and chairs because they're such high quality, prestigious items in an airline magazine, you know, that sits in the back of the seat in front of you when you're sitting on an airplane. So as a result, a few people who happen to be from country B who have decided to take this flight, they open up the magazine, they see the advertisement, they say, gee, that sounds like an interesting thing. I'd love to have one of these tables and chairs. So they contact some marketing person back at X, maybe there's a website address or a phone number, and they say, gee, we'll be glad to get a table and chair. Would you please send them to me? I will give you my credit card number, or I'll do a wire transfer or something. And X goes ahead and delivers a table and chair to Federal Express or UPS or DHL or whoever it happens to be, and the item gets delivered to the customer in country B. So we have X delivering the product to somebody who is going to deliver it to some customer. Could be an individual, could be a company, to somebody in country B. And we will say that in country B, the customer is the one that has to clear customs. Now, X has no employee of its own in country B. X has not really done anything inside country B. But under the terms, let's assume that the individual or corporate buyer of that table and chair takes delivery and also takes title at that time. Now, from a tax perspective of country B, does X have any presence in country B? Okay, I see a little bit of this, but it's pretty tentative. Now, what is the minimum? What is the minimum thing legally that is happening in country B right now Forex. Yeah, title passage. There's physically a table and chair that are inside country B, and they own it up to the point where it clears customs and the buyer takes it. Now, does that constitute a taxable presence? You're absolutely right. We don't know what the rules of country B are. But let's assume the rules of country B, which is pretty typical around the world. Let's assume that the rules of country B are the same as the definition of permanent establishment and the basic rule of taxation of business income that we find in tax treaties. Now again, we're going to look at that in more detail later on, but roughly that means, if we're talking about the permanent establishment definition, that there has to be a location. That location must continue for some period of time, and there must be business activity through that location. Those three factors. Now, there's also a typical rule, of course, in the OECD treaty, as well as in some number of countries that, in their domestic laws, that the activities of an agent may cause there to be a permanent establishment. So if you have an agent who regularly, habitually contracts on behalf of the foreign principal, then you have a permanent establishment. So let's, for the sake of our discussion, say that that's what country B's rules are with respect to permanent establishment. Now, taxation of business income requires two things: that there be a permanent establishment, and that income that is attributable to that permanent establishment is earned. If you have that, then there is taxation. Now, let's just take a moment in order to contrast this with the U.S. law that you know and presumably love as well. How does our U.S. law compare with this taxation that I've described? How about the permanent establishment? We don't have a concept of permanent establishment in the U.S. Rather, we have
U.S. trader business.
Yeah, U.S. trader business. Okay, and to get a U.S. trader business, the activity and what have you is a lot lower than the definition of permanent establishment. So just understand that there's that difference by comparison. What about what I said about taxation of business income? Permanent establishment plus income attributable to that permanent establishment. What is it in the U.S.? Okay, and effectively connected income. And how is effectively connected income defined? Does it limit itself to U.S. trader business plus income that is attributable to that U.S. trader business? Okay, no. What does it say? How expansive is it? Yeah, exactly. Force of attraction. The way the effectively connected income rule works is if I have a U.S. trader business, and also, by the way, there's some other activity which causes some income over here where there's, so to speak, no trader business that's connected with that income item. The simple fact that I have a U.S. trader business sucks in anything else which is which would otherwise be taxable if there were a trade or business. So it all gets sucked in, even though it has nothing to do with the trade or business we do in fact have. So that's a big difference between what the U.S. rules are domestically and your typical tax treaty, and also a lot of other countries that will not apply this force of attraction. Okay, now let's go back to what really got us onto this specific part of the discussion, and that was that we said that X owns some inventory that is physically within country B at the time just before or between imports, or between the time it's brought into country B and the time that the customer takes it out of customs, completes customs procedures and takes it out and takes ownership. Now, would X have a taxable presence? Would X have a permanent establishment? Yeah, no. Again, those sort of four things: location, duration, business activity through the location, and then sort of the fourth thing is an agent. Dependent agent is the term that's usually used. So we don't have that. Now what we're going to do is we're going to try to add additional activities. And when do we cross the line? When do we reach that threshold level which will cause us to have a permanent establishment and potentially income attributable to that permanent establishment? So that's what we're trying to do as we're building this up. Okay, so X finds that there's enough people and companies that are ordering tables and chairs because of the ad in the airline magazine. They start to think, well, gee, maybe we should add in the, put ads in the local equivalent of Vogue magazine. Or, considering the product, maybe we should put it on the side of buses that are running around through the streets of the major cities of country B. Does that cause X to have a taxable presence? Is that going to cause X to have a permanent establishment? What do you think? There's buses, is a bus a fixed place of business? I don't know. What do you think?
You're getting closer, but no.
Yeah, getting closer, but no, we're not there yet. Okay, what else could we do? Let's say that X says, gee, if there's all these customers that are now trying to order things from us, we really need somebody to collect orders or somehow sell locally. So let's say that X enters into a distributorship agreement with an unrelated distributor, and they agree that the distributor will buy and resell to customers. The distributor will advertise, the distributor will maintain inventory, the distributor will do a lot of things, but and then of course regularly buy from X based on sales. Does X have a taxable presence in country B? Let's say that let's say that D may be a really wonderful company for distribution, but maybe D is not financially, very well off. And as a result, D cannot purchase the inventory that's necessary to keep on hand. So that what happens, X sends product to D, but retains ownership. So X has inventory sitting at the warehouse, which might be a bonded warehouse, but might be bonded, might not be. X sends inventory and has it sitting in country B. Will that cause X to have a taxable presence in country B?
What's a bonded warehouse?
Okay, good question. Thank you for asking. A lot of countries will have arrangements whereby foreign persons can ship in product and they do not go through customs. They are stored in what's usually referred to as a bondum or customs warehouse. And they have not yet crossed the customs border, so as a result, there is not yet any import duty imposed, not yet. And if they have a value-added tax system, which is very likely in this world today, there will be no value-added tax at importation applied. So it means, from a very practical standpoint, a deferral of import duties and value-added tax. On the other hand, because obviously this is a rather major incentive to use bonded facilities, the storage cost of using bonded facilities is usually quite a bit higher than using something that is already past the customs border for storage. So usually there's a difference there. There are some countries where the domestic law, yes, would perhaps want to try to grab some tax where there is inventory in the country and the inventory is being used in a sense for regular sales. But under the OECD rules, probably this would not be a presence. Probably would not be. And notice that the place where the inventory is sitting, is that really a place of business of X? Well, it certainly doesn't have X's. It probably doesn't have X's name up on it. It's probably legally, part of these facilities. It might be considered a location. It might be considered to last for a duration of time. But is X itself really conducting business through that location? No, probably not. Let's say that X and D are having some conversations, and D says, these are really wonderful tables and chairs, but these are kind of high-tech tables and chairs. And we really need some support in making sales, because our people, my salespeople, they have trouble getting across technically how you use these tables and chairs in different customer situations. We really need some technical support. So let's say that X says, okay, well, why don't I send one of my technical people, I will send him out, and he will work alongside your people. He will provide training. He will provide technical support. He may go along on your sales calls and help the situation, what have you. Does that cause X to have a place of business? Does that cause X to have a taxable presence in country B? Now, part of the fact pattern is going to be what is the legal status of that person in the country, and how is he paid? Now, one possibility is that he just comes out and he continues to get paid by X, and there's just no charge to D for his services. And in fact, in reality, a lot of times, that economically is what's going to happen. Because X knows that if D gets proper support, there will be a lot more sales, and that will more than make up for the cost of having the individual there giving the technical support to D. So very often, there will be no charge. Well, what do you think? This person we described as giving technical support, doing training for the people who are working for D, possibly doing training for customers of D, going on D sales calls. What do you think? Does that cause a taxable presence in country B of X? What do you think? Remember, we said location, duration, and business activity through that location. Let's assume that, in fact, D gives the guy an office and a chair to sit in, desk to work at, to put his computer at. Well, yeah, maybe that's a location. He's there for the next few years. Gee, sounds like duration. But what about business activity?
Well, he doesn't contract with anyone in that country, so I don't see any business activities. There's no revenue coming from his presence there.
Yeah, I'll rephrase it slightly, but that's exactly right. In this kind of a situation, whose business is he helping? He's actually helping D's business. He's actually helping D's business. Now, indirectly, of course, yes, that will hopefully result in more sales to D by X. But in terms of what he's doing, he's not earning any direct income for X. He's not performing an income-producing service. He's doing some support for D, and if you look at X and you say, well, what's the main income-earning activity of X? And that's manufacturing and selling products, desks and chairs. So this, of course, indirectly helps that, no question. But it's relatively remote from the main business of the company. Now, later on, you're going to hear the term preparatory or auxiliary. There's an exception within the definition of permanent establishment in most treaties for preparatory and auxiliary activities. And these are fuzzy terms, no question. But probably this kind of thing is going to be an auxiliary activity because it's really remote, and there's no way, even if you could, even if you did want to say, well, gee, it's really an important activity and it's major in regard to this, it's difficult even to figure out how much income results from this because there's such a distance between gross profit on sales for manufacturing a product and a support activity in one country. So this, I think, is reasonably something which is auxiliary. Okay, now let's get back to the blank page, blank piece of paper point. Now, this individual who's coming over, let's say that country B's rules are such that they would perhaps see this as maybe creating a taxable presence. Is there something else that we could do that would avoid this kind of thing? This individual here is coming out as an employee of X. You, again, reading the overview, you should have come up and seen a term which is secondment. To second an employee is to effectively loan that employee to somebody else. And in loaning an employee, what makes it real is that that individual is, in fact, under the control and direction of the company to which he is being loaned. Very definitely, he is not, in any real sense, either directly controlled by or pursuing the business of X. He's pursuing the business of D. And to make this the strongest possible, we could have him, in fact, become an employee of D, paid by D, and under the distribution agreement, maybe we adjust our price in some manner to economically account for the fact that they are bearing locally the cost of this employee. So maybe instead of selling tables at 100 per table, maybe the price goes up to 102 per table. I'm sorry, down to 98 per table, because D is bearing the cost of this additional employee. Now, I'm not talking about just having D reimburse the exact amount of what the salary, X reimburse to D the exact amount of the salary. Rather, what I'm saying is economically change the pricing of the product. D is paying the individual salary, and let's say we adjusted, because of that, the selling price of the tables from 100 to 98. Okay, that means that if D sells, relatively speaking, a lot more than expected, D will have spent a fixed amount on the salary of the individual, but now in buying, relatively speaking, more tables than expected, that 2 times the number of tables that they are purchasing from X is a relatively higher savings. And the relative profit and loss of each entity is different. Now, okay, what's the significance of this kind of thing versus just having X reimburse the salary to D. Well, if X just reimburses the exact amount of the salary to D, tax authorities in country B, if they wanted to, could try to maintain, hey, this guy was really just the employee of X. X is paying the exact amount of the guy's salary. D really was not involved in the line. But if you actually change the economics of the pricing so that it's not something that's just an exact reimbursement, but that the parties will either be, relatively speaking, a little better off or a little worse off, depending on the level of sales, now you have something which is economically real. D is bearing his cost, his salary cost. And if there are more sales than expected, D will make more money. If there's less sales, D won't make as much as it would have otherwise. There's reality to which company is bearing the cost of the individual. So the point I wanted to make in terms of, again, the blank sheet of paper is that you can define what the relationship is. You can define what the employment relationship is, with which company it is, if that's important. If it's not important under the situation, you can just leave them there as an employee of X. We could form a subsidiary and have them be an employee of that subsidiary, which keeps X clean but accepts some amount of taxability for the subsidiary. Looking at this, we see that we can build up quite a bit of activity physically within country B before we have any presence. Now let's say that we have a situation where X, let's say, has two distributors. Let's assume that there's D2 here, and the same technical support is needed, but because there are several distributors, X says, well, you know, we only need, let's say, one or two people, but they need to be able to go to this distributor or that distributor, or customers over here, customers over there. Maybe there are some customers who have bought directly from X and who did not go through the distributors, so we need to service them in some way. So let's assume that X says, gee, I want to have my own office with people in it, my own employees in it, for certain purposes. Now, those people might, for example, support the operations of the distributors. They might answer questions if customers have it. They might, again, like before, go out on sales calls with the distributors, provide technical support, whatever. Now, let's assume that all of those people, could be 1, could be 10, whatever. All those people in that office help out D and D2 and the various customers, and let's assume that there is no service fee charged by X to any distributor or to any customer. Any thoughts on whether this creates a taxable presence? There's no revenues from any of these activities. No direct revenues.
maybe you're not generating revenue specifically from that office, but that's kind of built into the price of the product. It's like people know products that, like, Mac has a good warranty, so even though maybe you've never been in the Mac store, buy your Mac, you bought it because that's there.
Okay, that's good. You're right. It's clearly important. It's clearly important. But getting back to this question of what's the nature of the income that X is earning? X is earning some gross profit from the sale of inventory to D1 and D2, and perhaps occasionally a direct sale. And X, if you tried to say, okay, let's say that the sales price of the product is 100, and the cost, let's say, is 60. Let's say the sales price of a product to D2 is 100. Let's say the manufacturing cost is 60, and then maybe there's other expenses of 30. And let's say that the net income in total from the sale of that one desk is 10. Now, how much of that 10 is attributable to these support activities carried out by these 10 people who are doing this function over here? Or maybe there's 100 people there, who knows? But how much of that 10 is attributable to them?
Did you say there's a permanent establishment then that is no income attributable to it?
Yeah, that's a possibility, yes. Technically, that's probably the most correct answer. That there might be a permanent establishment, but there's no income attributable to it. Or alternatively, there is no permanent establishment because this doesn't actually constitute carrying on a business. And you can go either way. The point is that, remember I said no presence, and then I said representative office, branch, and local legal entity. If we look at that second item, representative office, I didn't really define it when I brought it up before on the slide. A representative office is something that you find in a reasonable number of countries, whether it's actually in the law or whether it's just by practice. What it is some sort of presence of a foreign company, and the activities within that location, that presence, the activities are limited to certain defined functions. And those functions might be market research. The most typical language you hear is market research and a communications link or something like that. But it gets expanded in a lot of places and a lot of actual activities, actual situations of companies that are doing this, to this broader thing of sales support, or it's not just market research, but supporting local distributors, being a communications link, overviewing, for example, advertising that the distributors might do, being helpful in the sales visits, and so on. So when we have an office like this, typically that will end up being labeled a representative office. And that representative office in a lot of countries is accepted as being a non-taxable presence. Now, when I say non-taxable, what do I mean? Well, I mean primarily an income tax, a corporate income tax present, that there is no corporate income tax presence. There might be a presence, of course, for employment taxes, because they're employing people locally. They might have a presence for value-added tax purposes. But for the basic income tax, a lot of countries accept that this sort of representative office that limits its activities, doesn't make its own sales, doesn't accept orders locally, doesn't earn income from services. This is a non-taxable presence for corporate income tax purposes. Now, as you can imagine, what happens in real life is that as this office is there longer and longer, and operating people say, gee, we can do this, we can do that, we can do the other thing, the activities grow and possibly a revenue stream gets started. So for example, let's say that one of the customers says, gee, I need a little help on doing something different with my table, and I'm willing to pay you to help me do it. Okay, now we have an income performing service. Income producing service. Now, if you look at, of course, the definition of permanent establishment in the OECD model treaty, it'll be relatively clear that, again, location, duration, and earning service income through that location, that's going to constitute business. So now, that would cause us to hit the threshold where all of a sudden we have a real taxable presence, as opposed to either no presence or representative office, and that pushes us into what we term a branch. Now again, whether the branch is officially registered as a foreign corporation doing business or not, the tax rules will normally ignore that legal status and will just look to what are the activities. Do you have that duration, location, and business activity conducted through that? The tax rules generally ignore the legal status of whether or not a branch is actually registered. Let's draw a new picture, because there's one important point that I would like to make. Okay, here's X. Now let's say that X is merely one company in a large group of companies. And let's say that X has set up a representative office and is successfully selling to customers in country B and not paying tax in country B on those sales. Now, let's say that Y over here, which is another one of the related companies, let's say that Y says, gee, I'm selling screens, and people who need tables and chairs for their conference rooms, they need screens that come down and go back up. So, there's sort of a relationship here. The same people who are helping out X's sales from this representative office, those same people can help me with my sales of screens. So Y is going to be, making sales to its customers, And people from the representative office will help out in the same way that we've talked about the individuals helping out the distributor for X's products. What do you think? And let's assume, of course, since X and Y are related 100%, Y, X says, we're glad to do it, you're our brother, and we're not going to charge you for it either. What do you think?
X and Y, I mean, they're both 100% owned by the same parent.
Okay,
And
well,
they had knowledge of it, because
okay.
it's...
Okay, well, let's assume, you're absolutely right. Let's assume full knowledge. Now, I think a session or two earlier, we talked about the sanctity of the legal entity. Okay, there will be sales made by X in X's name to various customers. There will be sales made by Y in Y's name to various customers. The fact that they're related, they're still separate legal entities and generally would not be, let's say, seen in any consolidated basis. Now, the fact that they're related, though, is relevant, absolutely. Now, if you've got two parties who are related, and if one party does something for the other, and there's no charge made between them, what should immediately come to your minds? Transfer pricing, absolutely. Okay, so now a rather interesting question is, which comes first? The application of transfer pricing or the application of the definition of permanent establishment to decide whether or not X has a permanent establishment because of the activities of the representative office? Which comes first? Well, if the second one comes first, then you'd automatically say, well, gee, there's no income, let's not worry about it, and you'd go home. So maybe the intercompany pricing comes first. So in other words, in order to, before we can make the taxable determination on the representative office activities, we have to first, using good transfer pricing principles, determine what amount, so to speak, should be paid from Y to X that relates to the activities that they have performed, in fact, for Y. Now, whether it's $1 or $1 million doesn't matter. The principle is very clear that once you say, okay, services have been provided to a related party, we now have some amount of income that results from services carried out on a regular basis in that location in country B. And that means we have hit that threshold. We now have a taxable presence. Now, this is a principle, certainly, that is violated many, many times in a lot of countries. China, interestingly, whether the local authorities generally understand it or not is a different issue, but on sort of a national basis, the Chinese have their local tax authorities try to tax representative offices no matter what they're doing. I think part of that attitude comes from the assumption that, well, they're probably doing it for related companies, so they're not just doing it for themselves, therefore they do have taxable presence. Again, separate legal entity. Now, blank sheet of paper. Could we solve this problem? If we realize this is the case, could we solve this problem? What could we do? What if Y, instead of selling direct, sells to X and X resells to the customers? Now you've got the same legal entity which has the representative office. It's the one making the sales. Now it's probably going to have a pretty small margin because it's not going to, Y is going to get the bulk of the profits, of course. But you've now put the form of the transaction in a manner which will consistently allow the representative office to be only doing activities for the company of which it is a part. And as a result, you still are shy of that threshold. So let's go to the next step, which Peter had mentioned before, and that was, well, maybe if we think, for example, well, let's say we think that these activities are so close to being a permanent establishment that we're pretty worried about the tax authorities coming in and grabbing some unknown amount of our income from the gross sales on the product. So we're pretty worried about that. But we have to have those people there. So maybe one alternative is that we set up a subsidiary, let's say a NewCo, and the activities of that office are placed inside that company. And of course, since we now have two legal entities, we now want NewCo to be bearing the cost of whatever activities it's conducting and to earn an arm's length fee for those services from X. Okay, now what have we accomplished? What have we accomplished? Okay, the local company is clearly a taxpayer. It's locally resident company. Say it's managed and controlled in country B, or country B has residency based on country of incorporation, or whatever it is. But let's assume that the NewCo there is a local resident company taxable on its worldwide income. But now we get to define what that income is within reasonable transfer pricing principles. So X can still make its sales directly to the customers. Now, whether those customers are final customers, whether those customers are distributors themselves, really doesn't matter. X and NewCo can contract and define what their relationship is. Now, most typically, NewCo is going to be a service provider doing defined services as set out in a service agreement for X. Yes, NewCo will be taxable to some extent. Fine. Whether that's on some sort of cost-plus basis, which is accepted locally, or some other commission basis, which is arm's length, doesn't matter, but the point is you are putting some limited amount of profit within NewCo, and you are protecting the crown jewels. You are protecting the major amount of income that's represented by the gross profit on the sales that X is making. Again, sanctity of legal entity. The activities of NewCo, unless you do things really wrong, the activities of NewCo are not the activities of X. Now, we can sort of go on forever on this thing of, trying to build up from no activities to more and more activities. The extent of this kind of discussion is really without limit. But I hope that this gives a flavor of these four levels. No presence, which how much can you really do and still have no presence? Representative office, how much can you do within a representative office and still not reach that taxable presence point? Branch, which typically means that yes, we are conducting a business, we do have income, and then locally incorporated or locally formed entity. Yes, Jasmine.
Because in this example, I guess if it's manufacture and sale of products, it's easy to define what's being done. But X could probably still create a PE if there's a NewCo, if it sends employees on deputation to NewCo, and it's, say, a business process outsourcing unit.
Yeah, no, definitely
Because
X could still
X
trip
could
up.
still
Yes, absolutely.
create a PE, and I think chances of that happening are brighter when you have treaties, which are quite similar to the model tax treaty that we've been studying. And also if it's service-oriented work instead of manufacturer.
Yeah, when we get into discussing the treaties more specifically, we'll talk more about some of the treaties which also have provisions regarding services, a service PE as it's called, yes. So, yeah, you're absolutely right. I mean, each situation has to be specifically looked at in light of what local rules are, what treaties provide, if there are any, and the specific activities of the situation. But again, the goal of trying to go through this is to see how it builds up. And yes, I choose a sale of a manufactured product because that's the easiest to try to keep as clean as possible. Consolidated versus separate entity taxation. A few words about this are worth making. Now, notice the first point up there. Local company reporting in each country is normally on a separate entity basis. Even if you happen to have a holding company in the other country, typically each company is going to be treated as a separate company. There are relatively few countries that have real consolidated filings. I mean, China's a good example. There are many large multinationals that have 10, 20, 30, 40, 50 or more subsidiaries within China, and they are all separate companies which are treated separately. Yes, they have to worry about transfer pricing, of course, no question, because there is a relationship among the various companies and the overseas group members. But each entity is a separate taxpayer. There is no consolidation for tax purposes. What is the financial statement effect of foreign gains and losses not offset? Now, what do I mean by that? We have our situation here with 4 companies. Now, let's just take 2 of them and ignore the other 2. Let's just say that this one has income of 100, and this one has a loss, let's say, of 50. The first point is that, again, unless there's some local consolidation, which we're assuming there is not, the loss and gain do not offset. Now, for simplicity, let's say that the tax rate in the country is let's say 40%. So the tax here is 40, and the loss over here is 0. Or, I'm sorry, the loss is 50, there's no tax with respect to it. Now, there might be a tax loss carryover allowed, but that's a benefit for a future year. Now, let's assume that X up there is, as a lot of your clients in the future will be, is a company which reports its income to the public. And the public wants X to make money. The public wants X to be efficient in how much tax it pays. So, for simplicity, let's assume that these are the only items of income and expense within this public company X and its group of subsidiaries. X will prepare for financial statement purposes a consolidated income statement, consolidated balance sheet, and will pull everything together. So what will that look like if these are the only items? Well, X will show, let's say, net income of 100, tax of 40, and, net income of 50, which is the 100 minus the 50, net income of 50, tax of 40, and net income after tax of 10. So, a tax of 40 on a net income of 50 is an 80% effective tax rate. Now, that does not endear management to shareholders. And whenever you have, in an overseas country, losses and gains which do not offset, and of course I'm ignoring home country tax and foreign tax credits and so on, I'm ignoring all that. But just focusing solely on this, if you have offsetting income and expenses which economically offset but which do not offset in the local tax computation, you can get this sort of terrible result. I mean, if this loss were 100 instead of 50, then we'd have 0 income before tax and tax of 40 and a loss of 40. I mean, that would look even more embarrassing than an 80% effective tax rate. So one of the things that's very inherent to international tax planning is avoiding this kind of thing. Avoiding this. Now, how do you do it? Well, it's going to depend on the client situation. A lot of times, this kind of thing, but without the holding company, this kind of thing can happen quite often for a couple of reasons. One reason is that X up there may have many operating divisions that are separately managed and run. One division says, gee, we need a company over here in this country, and they go set it up. Another division says, gee, we need one in this country also. They set up theirs. And over time, there might be 2, 3, 10 subsidiaries in a country, and because of separate company taxation, they're just separate items out there, and if you have losses in one, you have this problem. Second typical situation where you see this, or let's say the cause of it, is where you have merger and acquisition activity. X buys another group of companies, does some major merger or acquisition, and all of a sudden X acquires Y, let's say, and Y becomes a subsidiary of X. But before that, Y, of course, already had 1 or 2 or 3 or 10 subsidiaries in country B. So now you have more. So I've seen a lot of situations where either of these two causes creates a number of subsidiaries within a particular country. As long as all of them are profitable, then normally it's not a big deal. But all of a sudden, if one of them starts to make major losses, which can happen, you end up with this terrible result. And trying to deal with this, figure out how to solve it for the future is an important part of this. Now, it might be merging some companies, might be transferring some activities from one to the other. I mean, there could be various things that you could try to do, but understanding this, the significance of this kind of issue is the point of right now. Okay, the next thing I'd like to hit at quickly is situation where we have X, we have Y. Let's say Y makes, again, 100. Let's say it's under a tax holiday at the moment in order to go to the extreme of the issue. And as a result, there's 0 tax at the moment. They have 100 of after-tax income. But they leave the 100 down in Y because they know that, number one, if they were to pay a dividend, let's say there would be a withholding tax in country B of 10, and let's say there would be another 25 of tax up here upon receipt of the dividend. So there's future tax when the dividend is paid of 35. Future tax of 35. We're not paying any today, but in the future, at some point, we're going to have to pay it. The issue is, what is the financial statement impact of this? What do you think an investor would want to know about this? Would an investor want to know that net income reflects this future payment of 35? Or would you think that the investor would want to just have current income being 100 in the consolidated, corporate financial statement, and as a result, feel like he had a better result? Any thoughts? Are you an investor?
I want to know both.
You'd want to know both. Okay, well, that's a good answer. Don't charge the 35, but disclose that it's there. But how many people read the footnotes where the disclosures are?
2 or 3.
If that many. The amount of time that people spend drafting footnotes in comparison to the number of people who actually read them is an interesting issue. But anyway, so the point is that this can be a rather major issue, because the numbers can get very large, because this is not just for 1 year, but this can happen every year for some number of years. Okay, although the rules between the U.S. and generally other countries that use international financial reporting standards, although the rules are slightly different, they basically say that if Y does not expect to pay a dividend anytime in the foreseeable future, the U.S. rules are a little bit heavier, saying that you don't ever intend to repatriate the money. Then you do not have to record the 35 of expense today. You can actually show 100 as being the after-tax income in the X consolidated financial statements. And you just disclose the 35. On the other hand, if management cannot really say that, they do have some plans or expectation that the money will be brought up, then they would have to record in the financials the 35 so that net income before tax 100, tax expense 35, income after tax 65. So the point is just understanding the financial statement effect of the benefits you're creating out here. That's part of this overall environment that you have to be aware of for your client. Again, don't worry about being an accounting expert in financial reporting. Rather, understand that this is part of the environment, and is management going to, how concerned or interested is management going to be in a savings thing here if he's got to record the taxes as an expense currently anyway? Now, yes, there's a time value of money, and yes, companies want to get the benefit of that time value of money. But the difference in management's reaction to something you might call a permanent difference, gee, we're never going to show that 35 as an expense, so gee, that's really wonderful, versus just the time value of that 35. There can be let's say, a different level of enthusiasm for one versus the other.
If one of those subsidiaries in the other country was losing money, and you don't want to show that on the financial report, you want to somehow get rid of it, is it possible to create a separate entity that buys that subsidiary?
Sound like Enron.
It's been creative.
Well, the issue is if you have something which is a real loss,
Yeah.
and you convince somebody else to buy it from you, if it's a real sale, then gee, that's fine. But the reality is the only way you're going to get Joey to buy your company is that you know, maybe in a side agreement, say that you'll buy it back from him in 6 months at a set price, which guarantees him an interest component. And these kinds of things were some of the things that Enron was doing. And hiding from the auditors the side agreements.
So there's no, I mean, so how do you get rid of it if you don't want that loss? I mean,
Well, the issue is to not have the loss in the first place. But
Yeah.
if you do have the loss, then unfortunately your investors want to know it.
right. No, but I mean, prior to the loss occurring, like, could you do some kind of thing between the subs to mitigate that loss, like if it's the same product or something?
Well, the answer, oh, here it is. The answer is that maybe there are some things you can do. If you realize, for example, before year end that this is an issue, well, maybe you can transfer some income-producing service activities where you can actually move the employees from the one company to the other. Now, in the local environment, do you have to have income recognized from that, or can you just transfer the activities over? Well, maybe you can. Some countries that would be fine. And then, you know, these activities get carried out in the loss company, and to the extent those activities generate income, now you have an offset. But on an after-the-fact basis, let's say normally there's not going to be a lot that you can legitimately do.
In the States, could you do that? Could you transfer employees to another subsidiary?
Well, let's say you have activities and you want to transfer to another one in the States, and let's assume that either you're not filing a consolidated tax return, or alternatively you're concerned about state taxation, where it's company by company, let's say. In such a case, you would have a transfer pricing question. If you're transferring a business, what is the value of that business? In which case, the company which is buying that business, you know, into which you want to have the income from the future services to be conducted, what will the consequences be of selling that business at some price which reflects that business's goodwill, which may cause current taxable income to the transferor, and maybe either no deduction or an amortizable deduction for the transferee. If I remember correctly, goodwill is, you write it off over 14 years currently, is that the 15, is it?
Under 197.
Yeah. That was a change that came about, I don't know, probably, I'm going to guess 10 or 15 years ago. Before that, goodwill was not deductible at all. You had all sorts of arguments as to when there is and is not goodwill and what the values are, so this at least reduces the argument. But anyway, you still have that issue of value of the business and the transfer price for it. So you have to decide whether it's still worth doing. We'll talk about government incentives, and then I think go to the Khoo case before we finish up. Now, we find government incentives certainly a lot outside the United States, but before we focus outside, what about inside the United States? Do we see government incentives actually in the U.S.? And interestingly enough, of course, we do. We do find, especially at the state level, various credits and exemptions from state tax, not only income tax, but property taxes, training grants, financing arrangements, low-interest loans. I mean, there's all sorts of things that states will try to throw at companies to try to get them to locate. Especially if you're involved in something that is labeled high-tech. It's a very, very attractive thing, because the hope, of course, of local officials is that, number one, high-tech sounds wonderful, number two, maybe it's the next Microsoft. There may be, for example, some sort of high-tech industrial park where you find good facilities at a low cost. So we see quite a bit of this. This is the best example, which is, of course, very close to home since we're here in Seattle. You try to imagine with Washington's current budget problems that there were, the state specifically offered, according to this newspaper article, up to $3 billion over 20 years in terms of tax breaks for Boeing if they place the facility here in Seattle. So these are some pretty major things. And other states that were clamoring for Boeing's facilities were equally as generous. Okay, so what do we find overseas? Well, we find a lot of the same things that I just mentioned for here, but typically in various countries we find income tax holidays and investment allowances. A holiday is normally, let's say, zero tax for 5 years. And an important issue in that is, well, 5 years from when? Is it 5 years from the approval of the grant? Is it 5 years from the year that you first make profits? Well, what is it? And this can vary by country and can make a big difference, because if you have an operation that's going to have 3 years of startup losses, maybe the holiday isn't worth very much if it starts at the date of approval. Investment allowance normally means a tax credit equal to a percentage of the investment in plant and equipment, or whatever the defined base is. Here in the U.S. for many years we had an investment tax credit. A withholding tax, reduced or zero withholding tax on interest or royalties from overseas loans and licensing of intangibles. Now, very often this will be something where it's a specific approval on some sort of technology, or maybe a long-term loan with certain minimum provisions as to length, interest rate, and so on. Okay, so export incentives, free trade zones. What's a free trade zone? Any idea? Say you're a company which processes certain raw material into certain components which you sell. Well, if you can, you might, for example, have the facility where you do the processing inside a free trade zone where you import the raw material, you process and create whatever component or product you're producing, and you export it, and it never comes within the customs border of the country. So there's no import duty on the raw material, there's no value-added tax, and of course no export duty when it leaves. So this can be a major thing.
So it's the company's just physical factory or compound?
It might be an assembly or a processing plant. Might be even just potentially a distribution center. Or maybe you have a distribution center in, for example, Singapore, where products will be brought in from overseas and then shipped out to other countries around the region as the sales are made.
And
That
the
sort of
benefit to
thing.
the local country is jobs primarily?
Oh, yeah. Yeah, a goal is economic growth and jobs. Ideas to make it easier for foreign companies to be doing business there. I mean, reading the history, especially of Singapore in this regard, is just an amazing story of the country consciously trying to figure out how do we get jobs to our people? How do we attract employers? So Singapore has been sort of the gold standard with respect to incentives. And if you choose Singapore as your country for assignment 2, you'll see just an unbelievable number of different incentives that are very fine-tuned. And Malaysia has followed Singapore pretty closely in a lot of those things. Okay, so industrial parks, financing, training grants. Now, we also find in a lot of developed countries, as opposed to developing countries, provisions for regional management centers. In other words, bring all your high-level management for the region into Shanghai and have your regional headquarters here. Philippines also has this kind of headquarter thing. R&D tax incentives. The last figure I saw was that I think 35 countries around the world have some sort of R&D credit or R&D super deduction where you can deduct either 150% or 200% or some multiple of the amount of actual R&D expenses that you incur. Special holding company regimes, you find that reasonably often, so that companies will encourage there to be, countries will encourage there to be holding companies along with the management that's there, and there's dividend flow through the country, and it obviously helps from an employment and business center perspective. Now, notice that from those two long lists, China either currently has or had, prior to 2008, virtually all of the listed incentives. Historically, China started out somewhere around, let's say, the late 70s, to think about, how can we bring in technology and just work. And they started having benefits for companies which were owned by foreign parties, at least 25% or more, various benefits, and that grew and was tremendously successful in encouraging, along of course with low wage rates, in bringing a lot of companies into China. And with the tax reform in 2008, China basically said, hey, we now understand that people are coming to China not only because of low wages, but because they have to be here. We have 1.3 billion consumers, and the percentage of the consumers that are affluent and able to afford products from the world market is growing. As we saw on some slide a couple of weeks ago, a majority of companies are now looking at the Chinese market, and they're in China not because of tax incentives. They feel they have to be there, and China consciously said, well, gee, we don't have to give tax incentives any longer, and got rid of most of them. Notice certainly in some countries incentives are negotiable. So that could be an issue. Now, an important question is who benefits from a host country incentive? So let's draw a picture. Here's our usual picture. B has granted Y an incentive so that there is no tax, let's say a tax holiday. There is no tax on the income that Y earns. And further, let's say there is no tax when a dividend of 100 is paid to X. So no withholding tax. Now, remember when we talked about the way that double taxation is avoided? We talked about countries that exclude foreign income, and we talked about countries that have a worldwide system with a foreign tax credit. So let's first think about what happens in the case that A grants an exclusion from income of dividends from a foreign operating company, so that X receives the dividend of 100, has 0 tax. So income 100, taxes in country A is 0 because of the exclusion. Now that's a wonderful answer for the taxpayer. They get to keep all of the money that country B did not collect. X gets to keep all the money that Y did not pay to B. Now let's assume that the regular tax rate, if Y had been fully taxable, would have been 30. So that if Y had been taxable, there would have been 30. So when there is an incentive like this, understand that country B is actually giving up 30 of tax. It is costing country B 30. It may not be a physical expenditure, but it is a real cost. It's a real cost of granting the incentive. Okay, now let's say that A is not an exclusion country where it exempts foreign income, but rather let's say it's a worldwide taxable or worldwide taxation, and that it grants a foreign tax credit. Now, how much is the income? How much is the income to X under country A's tax rules if there's worldwide taxable income? 100, yeah. Because the actual dividend that Y declared was 100. There was 100 of retained earnings, and Y goes through properly declaring a dividend and making the paperwork and showing a dividend of 100, and they physically pay 100 to X. So our income is 100. Now let's say that our tax rate in country A is 35. So we get tax of 35. Country A grants a foreign tax credit. Let's say they even grant an indirect tax credit. How much tax credit will there be to reduce that 35? Yeah, none. Exactly. So that the tax is 35. Now, what do you think country B thinks about this? Country B has really spent 30. And all they've done is passed that 30 to the government of country A. X has not realized the benefit of this. Is country B happy about this? Yeah, probably not. Probably not. Let's ask a couple of things. Number one, does X in this situation still want to try to do whatever necessary to get B to grant a tax benefit, a tax holiday, if country A is just going to take the money away? Do you think that X is still excited about this, or does X say, I don't care? You know, it's just going to be more money I have to pay to country A, so I'm not going to bother to even apply for this tax holiday status. What do you think X is going to do?
This deal for B is not that matter because they're getting paid on the back end.
Yeah, on the surface, that does feel like the right answer. But it's not the experience we see. And the question is, well, why? In other words, when I say it's not the experience, you know, having been in the position of trying to help the X's of this world secure the tax benefits of what B is offering, I can say very, very, with a great deal of confidence, that the X's of this world in this situation still not only want the tax benefit, but they will pay large amounts of money to advisors to help them get it. Well, why is that? What are some of the reasons?
Suppose if you didn't pay dividends, you can keep your money in Y.
Yeah, just not bother to pay a dividend. Yeah, exactly right. There's a time value of money. And Y down here, if it each year for 5 years, you know, gets this benefit of no taxation. Let's say it's a 5-year tax holiday and it builds up 500 down here, that may be very material. Now, depending on what the rules of country A are, CFC rules, other tax avoidance provisions, what have you, why might be able to use the money in new businesses, or why might be able to loan the money to related parties, or why might be able to even, some countries, loan the money back to its parent. Depends on the country and what its rules are. But yes, the X's of this world want this, and time value of money is a big part of it. Now, there's a couple of other aspects to this which can be important as well. What if X is in an excess foreign tax credit position? What if X is paying a lot of tax to some other countries at high rates and has excess foreign tax credits? If it can generate low taxed foreign source income, it's able to use those excess foreign tax credits. So that's a second thing. Now there's a third thing which is kind of interesting, and you're going to, I have a copy of an article that I will pass out at the end of class about this, and that is that looking at the U.S. Specifically in this case, the U.S. in 2004 granted a one-time benefit on bringing low-taxed foreign income home. And again, if I remember correctly, it was, instead of being taxed at 35%, it was taxed at only 5%. And if Congress has done it once, probably they're going to do it again, in another 5 or 10 years. So that's another reason to put as much down here as possible, because the hope is that at some point in the future there will be another let's bring the money home campaign where we tax it at a low rate, and now we have one of those permanent differences that gets management very, very excited. Not just a timing difference, but a permanent difference. So for these three types of reasons, even though on the surface you'd look at this and say, gee, X, just shouldn't care less about the tax incentive, reality is they do, and they go to a lot of effort to achieve qualification for these kinds of things. So it's very important. Okay, now let's go back to the situation. Remember we said that B probably is not very happy that all it's doing is transferring the money to the government of A. And because of this, a lot of country Bs have tried to negotiate in tax treaties with the various country A's something that is called a tax sparing provision. Some people pronounce this tax sparring, some people pronounce it tax sparing. In this case, in the left-hand column where the no tax sparring is, those are the same numbers that I had on the slide before. where the home country's tax is 35, there's no foreign tax credit, and of course, the tax payable to the home country becomes 35. And all of the benefit of that country B tax incentive goes to country A. Now, where we have a tax sparring arrangement, the typical thing is that the tax treaty between country A and country B will normally provide, and this is usually found in like Article 22 or Article 23, somewhere in there, of the treaty. You will find something that deals with the foreign tax credit. And they will define within that treaty provision that the foreign tax for purposes of country A's tax calculation will include the tax of country B, which would have been paid had there been no tax incentive granted. So, under that provision, country A allows that 30, which would have been collected, to be put into the tax computation as if that tax had been paid. And we end up, of course, with 5 paid to country A, and that means that the benefit of the tax incentive actually went to the taxpayer, company X, and not to the government of country A. Now, interestingly, the U.S. has always refused to enter into any tax-bearing arrangements. So, presently, at least to my knowledge, there's no tax treaty that the U.S. has that includes tax-bearing. But some number of other countries do have it. And as you can imagine, because this is really giving something away, in other words, country A is really giving away some potentially sizable dollars by this kind of a provision. Usually, although not always, usually these provisions are very specific as to which tax incentives will qualify for this treatment. And secondly, they may be for a stated number of years, after which they will expire if not extended by a protocol between the two countries. Because country A is really giving up something significant in this kind of thing. Now, the existence of tax bearing is easy to miss because you've got to go and find it buried within a treaty. You can't, I'm not sure that there's easy places to find it. You've just got to go to, let's say, possible relevant treaties and see if it's there. These are a couple of examples from tax treaties that have tax-bearing provisions. So just read through those two so you can see what to expect. Notice that the first one is very specific. It lists out very much specified tax incentives. The second one is very general and is not as typical as the first kind. When let's see, last week we suggested that you would give at least a few minutes of thought to what questions you might ask. And then, of course, secondly, well, what are some of the issues that we need to think about? There's no right answers, no wrong answers. We're not going to solve any issues here, but we're trying to, again, give an example of a discussion of what questions do you need to ask, because that's such an important part of what we're doing. Summer, you're smiling.
Oh, no.
What do you mean, oh no? You should be thanking your lucky stars that you have the opportunity to go first and not have to look hurriedly through your list to see if you have any that haven't been mentioned.
Okay, so I guess one of the questions I'd ask is, does Khoo Holdings plan on purchasing the manufacturing equipment in the foreign country?
Okay, you mean in the foreign country
That it plans to go to.
that it plans to go to?
Yeah.
Okay, and okay, now that's excellent. Okay, and then what sort of follow-on questions might there be? Let's say the answer was no, they expect to get it from somewhere else.
I would probably ask them where they're going to be purchasing it from.
Okay, let's say the answer is from India.
Okay. Are workers of the prospective country that they're entering into, are they going to be putting together this equipment that they're purchasing from India?
Oh yeah, in fact, a number of people from India are going to come over and be involved in the installation process.
I think that's all.
Okay, well, okay, those are good questions. But what I'd like to do is, again, from the standpoint of trying to get across how one question leads to another. Okay, if there's going to be a number of people coming from India who are going to be involved in the installation, maybe the next question is, well, is the Indian company a related company or is it unrelated? Okay, if it's related, you've got a couple of things. One issue is, of course, transfer pricing. If it's unrelated, I'm sorry, even if let's stay with related. If it's related, you've also got the concern, because although we're only talking about the Malaysian operations of this thing, but if the company's related, we as good professionals need to also raise the question of, well, is the Indian company, because of its employees being in Malaysia, for example, potentially either creating a PE or somehow being taxed? And there's not only the potential taxation of the Indian company, but what about the Indian individuals? Each human being is a taxpayer, a potential taxpayer. This is, like I say, a great honor. See, you are a potential taxpayer, Joey. Okay, so you're always looking for what's the follow-on question from what you've learned. Okay, let's say the Indian company is unrelated. Well, probably you don't care in the sense that, well, their taxation is their problem, not ours. On the other hand, well, maybe there are some local rules regarding withholding taxes on payments for services that are conducted within the country. Malaysia happens to have it's a 15% withholding tax on technical services. Well, gee, what exactly are the nature of this installation work? Is it just, you know, screwing a few nuts and bolts in, or is it some more serious project? So, again, asking questions, and then based on the answer, well, what's the next thing to ask? Okay, Andrew.
I guess what remittances, I'm going to split this into a sec, are these subs making to the holding company in Singapore? So are they paying dividends? And then the second half of that would be, it's the royalty. They're licensing IP rights, so it's the royalty.
Okay, you're speaking of the existing subsidiaries, or you're talking about the new ones that would be set up for these operations?
Both, I guess. Well, they're planning on killing the Singapore manufacturing when it goes obsolete. Is that correct?
Well, that's a good question. You know, if there's reasons to keep it, then, you know, we might keep it. But yeah, at the we're expecting, if we move the facilities offshore, we're going to eliminate a number of employees. We're going to give up our lease on the space. So yeah, in fact, you know, it's going to cost us a lot of money, and we're going to end up with some losses, you know, in our final period inside that Singaporean company.
So with the new operations, once they become, and I understand in the first few years they'll be operating at losses, is there going to be dividends paid to this? How is it going to be structured? I mean, are the licensing agreements such that a lot of your profits, or you're able to kind of pull your profits out under their royalty payments, or is there dividend payments? How are you going to get money back to the mother, if at all?
Yeah, you're asking some good questions. I guess, you know, I'm of course looking to you for advice on, for example, whether I should even have a royalty. You know, should I be transferring ownership of technology to the new Malaysian subsidiary? Should I grant them a royalty-free license? You know, I don't know, but anyway, getting back to your question, clearly I'm going to have to transfer to them the right to use certain software that goes into the product, as well as train local workers on production processes that we perfected inside Singapore. Now, this raises the question of, you know, if we have a royalty-free license, for example, or just we don't even bother with a license, we just train the employees how to do this that we developed in Singapore. Is Singapore perhaps going to want to value that amount, or value these processes that we've developed as to how to produce the hardware? There's not only the software that goes onto the chips that are inside the product, the finished product, but the manufacturing process and designs of the hardware itself. Are they going to want us to value that in some way if we don't have an adequate royalty? So, yeah, maybe valuation of those things and trying to look back and forth, would we be better off with a royalty, or would we be better off maybe with transferring for a lump sum? Now, we said that the ownership of the intangibles was up in Khoo Holdings. It's not down in Khoo Manufacturing. But we also just said in response to a question that Khoo Manufacturing is going to have some losses when it stops operations. Now let's assume those losses are material. If you have no consolidated reporting where losses offset the income of related companies, no consolidation. And if you have a company which liquidates and goes out of existence and it has losses inside, what do you think happens to those losses? Do they survive and go somewhere else? Yeah, probably sayonara. Okay, so if that's the case, maybe part of the thinking has to be, well, is there any way to minimize the losses that get realized in that company? Are there some things in connection with the transfer that we could value so that we, in fact, generate income to use those losses, but create amortizable basis in the new company, which will give a tax benefit at some point in the future? So that might be something. Okay, who's next?
I had questions about the structure of Khoo more generally. They're saying, you know, it's privately owned, so is it a couple people own this? Who's owning this? What are you structured as? Like, we're going to say shareholders, but I guess we don't know. Are you a corporation?
Yeah,
I'm assuming.
you're absolutely right. We don't know exactly what form of organization it is. We don't know who owns it. As I recall, I think it said it's resident in Singapore. But where are the shareholders? Okay, now, Singapore isn't the best example for this because generally foreign income comes into Singapore without tax and can go out as dividends without tax. So it's probably not a problem to keep Singapore in the line, so to speak. But there's a lot of countries, for example, the U.S. being one, where if you have a non-U.S. shareholder of a U.S. corporation, and that U.S. corporation has an investment outside of the U.S., you bring, let's say you bring a dividend or interest income in, it's taxable, and then you pay a dividend out, that's taxable in the U.S. So you're creating an extra layer of tax. Now, your question is perfect because, for example, if the owners of Khoo are in some other country, potentially there could be a benefit. Again, probably not because of the nature of Singapore, but there could potentially be a benefit if they owned either directly that, say, Malaysian company or Chinese company, or through some other treaty country, and did not necessarily make this new operation a subsidiary of Khoo Holdings. So, again, you could look at it once you find out where the owners are and see if there's some issues that need to be thought about. Maybe there's a different ownership structure that would be better. Now, another thing you might ask that's sort of along the same line, I'll wait and see if somebody else asked the question. Let's see, anything else?
In a similar vein, just it says it owns a number of wholly owned subsidiaries, so just kind of get a better sense of the overview of that corporate family. I mean, do they already have 3 subs in Malaysia or in China?
Yeah.
And are they all wholly owned, or are they, what's the ownership of all those?
Yeah, exactly. And yes, it might make sense. Gee, should we operate this as a division of a company we already have somewhere? Is that possible? Are there benefits, are there problems with that? Does it allow us to offset the startup losses within that country against income from some other operation? Eric?
Yeah, a lot of my questions are mostly going also to the types of business entities, but then I kind of realized a lot of these questions are almost more so for me. Also, especially moving out to China, what sort of business entity do you wish to establish there? And also, just because this might exist within the context of Singapore, doesn't necessarily mean we'll be treated the same way in China. But these sort of come back to me. Also, moving on to the patents.
Good.
They said there was some doubt as to whether China would respect their patent. Is it currently registered in Singapore? What treaties are in effect to, also protect these patents in other countries?
Okay. This area of intellectual property, the tax issues regarding them, but especially in China, the more important issue of theft of your technology. I don't know whether any of you have gone through all of the handouts, but one of the handouts was a short essay on the, let's say, the lack of respect for intellectual property in China. And protection of your technology is a major issue. So, without going into details now, because we certainly don't have time. The point is that yes, it is important to the company that they protect their technology, and the company would be looking to us as professionals to help them structure something which does that to the extent possible, and to understand their risks. Now, of course, we would be working with local counsel in that country to get more background so we can help the client. But again, understanding the factual background of, gee, what's the nature of this technology, the basic technology, what is its nature such that they're comfortable to have it there. There's two aspects. There's legally having it there, and there's the other aspect of, well, through training, through manuals on how to do operations and so on, you effectively transfer the knowledge to people, and if they leave and go get employed by somebody else, or they start their own business, your knowledge has gone out the door. So understanding a bit more about what they're doing helps you respond. Again, I'm not suggesting that we're all going to become experts in intellectual property law, but we need to get a feel for the business issue of protection of it, and then working with local counsel to see what's realistic for the circumstances.
Yeah, I also thought like certain things, maybe not in this instance so much, but what if some other company in China already had patented extremely similar?
Yeah, absolutely. That would be an issue. Okay, what about future objectives of Khoo Holdings itself? Let's say Khoo Holdings, which is closely held now, you might ask them, well, are you expecting to continue to be closely held? Is Is this a long-term thing, or are you expecting to do an IPO, a private a public offering in a few years? Well, if they said yes to some sort of an IPO in a few years, then that makes quite a difference in terms of wanting to have a parent subsidiary structure that allows a parent company to go public, as opposed to having a lot of, let's say, subsidiaries which might be owned directly by the principals, the individuals who are behind Khoo Holdings. I think you had mentioned also, of course, where the shareholders, if any of them that are, or let's say if a number of them are in a country that has CFC rules, that could make a difference as to your planning. Also, if you're looking toward an initial public offering, you probably want to be, let's say, even more serious than you would otherwise be about dotting your I's and crossing your T's, making sure that intercompany transfer prices are proper and so on, because public companies, management of public companies doesn't like surprises.
Probably those third-party loans, the loans that they're making between each other, they have to make sure that those are documented.
Yes, exactly. Okay. The goal here was to, again, get a flavor of discussing these kinds of things. There's factual things that you're asking about operations, and there's factual things that you're asking about legal matters such as ownership structure and where the owners live and form of organization and what contracts there are between the different parties and so on. Those are background questions. And then issues become, well, okay, what form of organization do we want in Malaysia? If there's going to be all this expensive equipment that we're getting from India there, well, do we want it to be there owned by the Malaysian company? In which case our capital structure has to support this big cost of the equipment. In other words, either we have to bring money in by way of equity injection in exchange for shares, or we have to have shareholder loans or outside loans.
There could be thin capitalization rules. Like
Yeah.
here you don't have them, and they're being exploited, but sooner or later they'll come.
Yes, exactly. So if there's thin capitalization rules, that might affect how much comes in by equity, how much comes in by debt. We'd want to look and see whether having a leasing arrangement instead of an ownership within the Malaysian company, for example, would make sense. The ultimate thing is, of course, you get the equipment inside the country as part of the business operations. But how you get it there is open to your figuring out what's best. Could be leased from a third party that's not related, if they're willing to finance their sale of the equipment, your purchase. Or you could have a related company buy and lease. And that related company could be anywhere in the world, wherever you want to put it. Is there a country that has a good tax treaty that zeroes out withholding tax on lease payments coming from Malaysia? If there is, then maybe that's an idea. So this sort of thing where you get an answer to your question, and again, as your experience grows, the automatic next question will arise to you. And this is sort of the flavor of what I'm trying to get across. Okay, before you escape for the evening, any other comments, questions, or otherwise?
When will we be receiving your responses or our information for the case then?
Yeah, my goal is to get it to you by Friday.
Okay.
Thank you and good night.